Hello, what's up guys? Welcome back to this YouTube channel, IP Boys. In this video, I'm going to explain to you guys market structure and type of market structure we have in trading. So if you want to trade market structure works in every market that you trade. If you want to apply this type of trading strategy to your trading, both even though you are trading crypto or you are trading synthetic indices or you are trading stock or currency pair, this type of trading strategy can help you in every trading aspect, all aspects of trading. So what do we mean by trading type of market structure? We have a lot of market structure. When it comes to, we have trending market structure. In terms of trending market structure, we have uptrending market structure and we have down trading market structure, and we also have the one which we call sideways market structure, or you can call it ranging market structure. If you watch my chart right now, we are on a currency pair, Euro USD to precise. You see that Euro USD is on uptrend because it's breaking higher highs structure. So what do I mean by that? Well, if you want to trade market structure, you must make sure that if the market is going up, you must make sure that the market is breaking previous high. So once market break the previous high, then you wait for a correction. Understand? Once market correct its move, or you can call it retracement, or you can call it pullback, then once market pull back, then you enter on the level which you want to buy from. Then the market will continue its structure movement. So this is what we call market structure. Once market is going up, it's giving you higher high structure and higher low structure. Understand? So all you need to be doing is to keep buying on the lower low structure to continue for buy. So if this was a downtrend structure, all you need to be doing is to do sell on the previous higher high structure. So what do I mean by that? If I'm to invert this, that means the market is now on a downtrend. So once the market is on a downtrend, once market give you this low, then you sell from here, then it give you a new low, you also sell from here. So that is a downtrend market structure. So without not wasting time on this video, let me invert this. So this video course is going to carry you in a long way. If you want to master trading, you must make sure that you master what we call market structure. So let's go to our dashboard. So this is today's lesson dashboard. So if you watch what I draw here, you see that we have two examples, the trending market, and we have the sideways, or you can call it ranging market. So these are two types of market structure in general that you will see in the trading on your chart or on any chart you use. So the first one, I'm going to explain the first one. After that, I will be explaining the second one. The first one is the trending market structure. The trending market structure, we have the uptrending market structure and we have the downtrending market structure. So I have to zoom it a little bit so that you can see what I'm trying to explain to you. Okay, so when you come to a trending market, we see the only thing you see is impressive correction, impressive correction, impressive correction. So when it comes to trading a market structure, you wait for markets to break the previous high, then come back. So let's say if you are using a trend line to trade, market structure doesn't select any type of trading strategy you use, whether you are a retail trader trading with trend line, or you are a breaker trader trading with psychological level, or you are a smart money trader trading with supply and demand. Neither any one you use, you also get it right when it comes to trading market structure as a strategy. So that's why I always say on my course that strategy is a basic thing in trading. All strategy works. The only thing is you need to know is to know the confluence, know the particular thing that gives you an edge to enter on a certain setup. So all strategy works, whether you're using a psychological level, trend line, supply and demand, or anything that you use to get a perfect entry for yourself. You try to be the best in whatever you are doing. So if you are trading, you must make sure that you'll be entering on a correction phase to catch the impressive move. So some people get very unlucky on trading because they always want to catch the correction phase before the main impressive move happen. So if you see this, you see that we are on this is an uptrend example. So in chart it doesn't look like this, it looks very rough in chart. So this is like an example of what you can see in chart. So when you come to the chart, you're not going to see this kind of line direction. You'll be seeing it on a candlestick formation, and candlestick is very, very low. So you make sure that you understand this on your best knowledge, and also rewatch this video even though you don't understand what I'm explaining more about. So if you watch, you see that we have an impressive move. The sharp move is called an impressive move, and this is a retracement. You can call it a retracement point, or you can call it pullback, or whatever. So the only thing you can do is to use a Fibonacci. Once price is making this type of formation, you use a Fibonacci. Let's use the second one. Price has already broken this structure, then this is the low. You use a Fibonacci to match from the swing low to the swing high. So I'm going to do that right now. So I don't know if I got this. Okay, from the swing low to the swing high, this is a swing high. Then I'm going to correct this is a low. So once you do that, the only thing you're going to do is to mount where your retracement levels are. We have this 50% retracement level, and we also have this 61.8 retracement level, which is our golden zone. So retracement points in higher time frame are based in these two type of neither price retrace on 50% or price retrace 61.8. Sometimes price can also tap your 38.2, but which I don't like entering my buy setup on this type of level, because sometimes price can tap to it and go up a little bit, and then it will come back to mitigate that level. So that's why the best level to take your buy setup on a higher time frame is 50% of the impressive move, or 61.8 of the impressive move. So if you are trading, you wait for it, then after that, then look for a confluence zone that gives you an edge to enter that buy setup. That's why you can use a trend line formation as a confluence to buy from here, or you can use a supply zone, because the supply zone is also a trading strategy on its own. So if you want to learn about supply and demand, the only thing you can do is just thumbs up on this video and comment on my next video that I'm about to post. I'll be teaching you guys about supply and demand in depth. So this is the first episode of market structure. The next video, I'll make sure that I teach you guys supply and demand trading strategy if you want to learn, because that is what I used to trade. So if you want, you can use a trend line formation as a confluence of this point, or you can use a supply zone, or you can use a psychological level. So you see that after price retraced 50% of it went up and break the previous high, which gave us a new structure of market going up again. So once price break this structure, all you need to do is to do the same thing. Map your Fibonacci from the swing low. These are our swing low to the swing high. Then after that, you wait for a retracement, or you can call it correction phase. So this is how you trade trending market structure. So for the downside, it's also the same thing. All you need to do is to just, let me invert this. So if I have to invert this, you see that it's also the same thing, giving us lower lows, lower high, and lower lows, lower high, lower lows, lower high. So you will be buying on the lower high, which is the correction phase. Understand? If you buy from the lower high with the correction phase, then you use your trend line or your supply and demand or your psychological level or your Fibonacci level. As far as the price has already give you a 50% premium discount price, then you can go short from there. So this is a very simple trading strategy course that I just want to give you guys. Some people find it very difficult to understand market structure because they don't want to pay attention in the lesson, or the lesson is so bored, or someone that is teaching you about market structure isn't explaining it well for you. So I made this course very simple and very understandable, that even a layman, a beginner, can understand what I'm trying to explain. So let's head to the second type of market structure, which is called the sideways market structure. So if I'm to explain this sideways market structure, you understand that this type of market condition is a type of market condition that isn't trending. It's always compressing, it's always consolidating from one high to the other low. So it doesn't move up, it doesn't goes down, it only stays at one side. It gives you this high, then and drop, give you this low, and come back to the previous high and touch. So once you're trading this, you must make sure that the market is giving you most touches before you can anticipate to sell from these points that I map this arrow. So the arrow that I point is where you will be selling once market gives you this touch. Understand? It gave you the first touch, the second touch, then you have to sell from here, then and go to the downside, and the downside gave you this first touch, this second touch, then you have to buy from here. So this is a very simple one, but I'm advising that this type of trading system is mostly advisable for expert traders. If you are a beginner trader, I don't advise you to trade this type of sideways market, because sometimes if you are not experienced in trading, you can always get stopped at with your stop loss. So the only people that can trade this type of market condition are experienced traders, people that have been in the market for a long time. So if you are trading, make sure that you are trading on a trending market. The trend is your friend. Follow the trend. Once the market is giving you a high formation, then you start buying. Then if it's giving you a lower low formation, then you sell. So the sideways market is not opposite of this trending market. The sideways market gives you a sideways market direction. It doesn't go up, it doesn't go down. The only thing it does, it gives you its trend on a sideways formation. So let's get to the chart so that I will show you an example of a trending market and also a sideways market direction. So if you are watching this, you see that we have a trending market direction at this point, that market is breaking previous high. You can see that where I draw this is a high, this is a high, and this is also a high, and also this is also a high. So you see that once market break a high, it return. Understand? Once it return, it touch your trend line as a confluence or your supply zone as a confluence, and then goes up. Understand? So once it goes up, it also break the previous high. So this confirms the trend as a uptrend direction. So if you are a retreat trader trying to catch a peak, you must make sure that market has breaking the previous high. Then you do your Fibonacci from the swing high to the swing low, get your 50% discount price from this point. Then you can use your confluence, neither supply zone, your demand zone, which you are seeing here, or you can use your trend line or psychological level to catch your buy setup, which as so as here you can see that market break this previous low, this previous high, then after breaking it, it came back to touch my hidden demand zone. Then after that, I went to my 15 minutes for my confirmation, and also I use this trend line as a point of confluence to capitalize from this trend. You can see after that, market went up and also break this previous high and also break the daily, this is a daily high. So currently now Euro USD is on a uptrend as I'm doing this video. So this is for a uptrend market. So if I have to invert this, you'll see that it's also example of a downtrend market. Once the market is on downtrend, is breaking previous low, it return, then break previous low, and it also return, and also break previous low, it also returns. So it's a very simple course to understand. The only thing you need to know is to know how to work with your Fibonacci. Very important to know how you can work with your Fibonacci and get the most move once the market giving you a lower lows and a lower high. So this is our previous low, because this one is not our low because it didn't break the previous low that market gave as a structure. So I took this as my previous low. So after that, you see that market gave us retraced above 50% discount price within this, the center of 50% discount price and 61.8, which where I found my supply zone, because I'll call this a hidden supply zone because it's breaking previous low. So if this has breaking previous high, I'll call it a demand zone. So on this type of example, it's a supply zone to me because market is breaking the previous lower low. So after that, you see that markets dropped. After dropping, it break this previous low. So what are we waiting again is that I'm waiting for market to give us a new, waiting for market to give me a new low, which they have given to me. They have given me a new low. Then after that, I will be placing my Fibonacci from this swing low, from this swing high to the swing low. So this is very simple for you to understand. So all you need to do is to just take your Fibonacci level, place it from the previous low, then take the other one, place it from the previous high. So from there you get your most retracement point in the market. So if you watch, you see that market is still on our that 8.2%. So we are still waiting for market to hit our 50%, but I'm not targeting to enter at this 50% because I didn't find my supply zones from this zone. So I'm targeting for a 61.8 level, which where I draw this arrow. So from there I'll be waiting for a confirmation and some confluence, which you can see that we had this first touch of this trend line, second touch. So here is going to be the third touch with my supply zone. So these are confluence that you use as a trading confluence. So all strategy works. It doesn't mean you trading smart money or trading ICT or trading any type of strategy doesn't mean that your strategy is all the best. Understand? Some people knows that their strategy is good, but they will still want to look for another strategy to try, because they don't think that they are consistent in what they are doing. The only thing you need to know is that once you master one thing in trading, you see that you will be successful and you'll be consistent in that one thing. that you have mastered. So let's head to a ranging market. If I got a ranging market, I have to show you guys. So you see that this here is a ranging market. You see that market isn't going up, isn't going down. It's only giving you a high and a low, a high and a low, a high and a low. So this type of market condition is very risky for a beginner, unexperienced trader to take position out from. The only people that can do this is experienced traders. So all you can do is to just follow the trend. The trend is your friend, and don't try to go against the trend. So I have to look for a good example of a ranging market so that I can show you guys more of it. So if I got one, I will show. Okay, here is a new example. This is also a ranging market. So all you can do after watching this video, go to your chart and backtest this type of market condition, so that whenever you come across it, you will know that this is a ranging market, that you don't need to take trade out of it. Understand? The market gives you this low, high, low, high, low, and high and low before breaking the box. So this is an example of a sideways market. So guys, just make sure you subscribe to the channel and turn on the notification bell icon